In June 2021, Novo Nordisk started the GLP-1 craze with its release of weight loss drug Wegovy, followed by Eli Lilly's release of Zepbound in 2023. Since then, there has been a large sell-off in medical or cardiovascular stocks, as seen here with Medtronic, Zimmer, and Pepsi, all down big time in a period where the S&P 500 has been booming. Despite this narrative that this wonder drug is going to cure obesity and render medical procedures a thing in the past, Boston Scientific has still been able to outperform and thrive. Their stock is up 145% since this June 2021 date, thrashing the market. In this deep dive, we will analyze what has caused this surge in Boston Scientific's stock price and whether it can continue to outperform. A bet on Boston Scientific's continued outperformance is a bet on two factors. First, that the secular tailwind of the aging of population will continue, and thus make more medical procedures required. And second, that Boston Scientific can continue executing and can continue to make smart acquisitions to grow their portfolio. As of last year, they've allocated $17 billion to M&A over 10 plus years. These here are just a snapshot of their most recent acquisitions. Now, both of these factors both seem likely to continue, and Boston Scientific will be able to continue being in the middle of it. Looking now particularly at Boston Scientific, and in short, they are one of the largest medical device companies in the world, focused on providing products grouped between cardiovascular and endoscopy, urology, and neuromodular markets. Cardiology makes up roughly 2/3 of their revenue and are what some of their most well-known products are known for. They provide stents for coronary artery disease and pacemakers for heart health. However, they're also acquiring companies in other segments to diversify and really capitalize on this tailwind that increased obesity and increased aging will drive the demand for more products. From a customer base, most of the revenue, roughly 60%, is demand from the United States, but they have been making an effort to diversify by growing into China and India, by investing in factories and R&D there. This seems prudent to start entrenching themselves in other countries outside of North America and Europe, because that's also another tailwind is the growth in population in emerging markets and economies outside the United States. Now, looking at financials, and their revenue growth year over year for quarter two was impressive, growing at 22% year over year. This is why the stock has surged so much. This revenue growth shows how necessary medical care is for a population that is more unhealthy and older than in previous decades. It is a medical device manufacturer that grows revenue at rates faster than a SaaS or technology company. Even when removing recent acquisitions, their organic revenue growth grew 17% year over year, compared to the company's guidance of only 13 to 15%. Best part of all is that they're growing revenue and not sacrificing profitability from it. Last year, their net income for quarter two was $324 million. Versus this quarter, it is nearly $800 million and a doubling of net income year over year. Financials look solid for Boston Scientific, as is their business mission to improve the health of patients around the world through innovative medical solutions. Before we run Boston Scientific through mine and my dad's framework to determine if we will buy now, please read the disclaimer in the description below. We're not financial advisors, nor anything we say should not be taken as financial advice nor a formal recommendation. Also, if you like content like this, please help us out and click subscribe, like, or comment as we aim to release weekly analyses about long-term, innovative-focused companies. Now let's go through Boston Scientific's valuation. First step for me to determine how to evaluate Boston Scientific's valuation is to look at where I believe they are in the business lifecycle chart. For comparison, Medtronic is a medical devices competitor which prides itself on returning cash to shareholders as a dividend aristocrat, so I would put them here as mature, and a price to free cash flow is how I would evaluate Medtronic. On the other hand, a tech company like SentinelOne with similar revenue growth rates as Boston Scientific but is not optimized for GAAP profitability, I would put earlier on in the growth stage. Boston Scientific does not pay a dividend, nor does it do much share buybacks, preferring to invest its profits in R&D or through further acquisitions. Yet, they're generating tons of profit from each dollar, so I would put them here as a growth company in the middle of SentinelOne and Medtronic. For companies here, I would like to evaluate based on a PEG ratio, which considers market cap, net income for PE, but also expected growth rates as well. When calculating Boston Scientific's PEG ratio, it is around at 2.8. On absolute terms, that is a lot higher than the standard PEG target of 1. However, I prefer to evaluate it against companies I own or on my watch list, who I would also evaluate based on PEG ratio. So Boston Scientific is a 2.8. The two companies we hold in this portfolio are New Holdings and Kospi. New has a PEG ratio of about a 1, and Kospi a PEG ratio of about 0.5. For a company on our watch list that we did not buy due to valuation concerns, D-Local, I also would evaluate them on a PEG ratio, and it is a 1.2. Thus, when comparing Boston Scientific's PEG ratio of greater than 2 for similar tech companies with similar revenue plus profit margins, it does seem that Boston Scientific is a bit overvalued. If we were to add Boston Scientific to our portfolio, 3 watchouts we would have for our thesis to monitor are below. First, they are a company that will grow by acquisition, so they need to ensure to not sacrifice quality nor due diligence out of a desire to continue to close deals to grow revenue by 20+%. All it takes is one bad acquisition for the stock to go in the wrong direction. Boston Scientific experienced this back in the mid-2000s with its disastrous deal for Guidant. Not only did they get in a bidding war that resulted in them overpaying and paying legal fines, but shortly after the deal had been closed, it had come out that Guidant had serious quality issues that would lead to recall and numerous lawsuits to deal with. Needless to say, Boston Scientific stock was struggling during this decade. Second point is we need to see Boston Scientific continue to grow revenue and profit by greater than 20% year over year for many, many years to command such a valuation. Any slip up or slowdowns, and there'll be valuation compression, and the stock will plummet. Related to this is the third point. Before any purchase, we need to rerun valuation assumptions. MedTech does trade at a premium valuation, so PEG ratio of 1 is not realistic. But instead, we should always find companies with a strong secular tailwind, as Boston Scientific has with an Asian population, to compare PEG ratios or whatever the valuation metric is at that time against to determine is Boston Scientific at a reasonable valuation. In running Boston Scientific through my 5-step framework, I first look at whether they have strong leadership. The company was founded 46 years ago, so it makes sense the founders are still not involved. The CEO, Michael Mahoney, has been in charge since 2012, responsible for fixing disastrous Guidant acquisition by his predecessors. Since then, they've made brilliant acquisition after acquisition to expand their product portfolio and the geographies they sell into. Great long-term focus with a capable eye for companies to add to the portfolio, so I give them a strong. From a valuation perspective, the PEG ratio of 2.8, which is much higher than the 2 holdings we currently have now, plus higher than D-Local, which we did not purchase due to valuation concerns. All 4 companies have revenue growth greater than 20%, strong profit margins, and strong secular tailwinds. So why would it be better to pay a higher valuation for Boston Scientific versus buying New, Kospi, or D-Local? I have this as very weak. Third point is revenue plus profit growth. I have this as strong, 20% plus revenue growth, and low double-digit profit margins, plus a doubling of profit year over year is very impressive. Fourth point is total addressable market. I have this as strong. Their total addressable market is massive, as is anyone in the world who needs healthcare solutions. They in particular have the cardiology segment cornered. The only reason that this isn't very, very strong is currently most of revenue does come from the United States, so they have not demonstrated acceptance yet at the APAC regions at the same level that they are in the United States and Europe. Last point is secular tailwinds, which I think is very strong. The aging population is something that is happening one way or another. There isn't anything to really do that can slow down that tailwind, as this is the era where baby boomers now reach the age where they need more and more medical procedures as they are advancing in their age. Hopefully, the obesity epidemic can reverse, so that would be good for humankind for the younger demographics to not need medical interventions so early on in their lives. Overall, though, Boston Scientific is a no for me. It's a great product and great financials, but it's just so overvalued. For it to get even close to add to my watch list, it would need massive revenue acceleration greater than 20%, coupled with profit margin expansion, while also maintaining the stock price, which, with all 3 variables happening at the same time, I don't see happening soon. So it's better to focus on companies that can more realistically add to our portfolio. What are your thoughts, Dad, as you run Boston Scientific through your checklist?
Okay, thanks, Scott. Very wonderful presentation. So I'd like to go over my framework. So as far as company fundamentals, Boston Scientific, Scott went through a lot of it, but basically I'm interested in it because of the tailwinds such as the aging population. And I think people are still, due to COVID, they still haven't done some procedures. So I think there's some tailwind to that as well. Some procedures coming up because of COVID a few years back, people postponed procedures. Anyway, looking at other things in the company fundamentals, Scientific does not pay a dividend. The beta is 0.66, which means it's less volatile than the market as a whole. And generally speaking, the market as a whole is the S&P 500. The earnings will be reported on October 22nd or 23rd. I'm neutral to positive on the company fundamentals. And then I look at the earnings history. 4 of the last 4 earnings were beats, so that's a good sign. That's very positive. The next criteria, the profit margin is positive 13.5%. I would rather have it above 20, but 13.5% is still good profit margin. So I give that a neutral to positive. The debt to equity is 49.1%. I prefer under 25%, but 50% is acceptable. So that's a neutral. The PEG ratio, as Scott was saying, is 2.8, which is for me a little high. I prefer it to be around 2, but you have to take other things into account for Boston Scientific, being that it's done so well these last couple of years. So I would say I give that a negative to neutral, the PEG ratio. And as we go down the list, the Bollinger Bands, it's between the upper band and middle band. So that's right now it's between the upper band and middle band. So that's neutral to positive, and it's very tight, so it's less volatile. So my hunch is it'll probably be going in a trading range. The moving average is 50-day is above the 200-day, which is bullish. The 200-day is sloping positive, which is bullish, and the price is above both, which is bullish. So that's a positive. And as I look at the RSI is neutral. Usually the RSI is usually neutral. There's very few times when you could get a signal from the RSI, but anyway, it is neutral. And then looking at the analysts coverage, the analysts I cover, there's 1 sell, 5 holds, and there's 9 buys and 1 strong buy. So that's neutral to positive. And the shares held by institutions is 91%, which is good. The higher the number, generally is good because it wouldn't be as volatile because institutions cannot get in and out of the companies as fast as retail. So that kind of is a pacifying effect on the stock. So overall, my thoughts are, my thesis is that I would like to put a quarter position in, but being that the macro of the stock market is so high right now, I think it's best to just put it on the watch list and wait for a lower price. But Boston Scientific is definitely one that I would like to pick up at some time. But like I say, the stock market as a whole is priced so high right now that I personally think we're due for a pullback in the short to midterm, but nobody knows, of course. But that's just my take on it. Scott, back to you.
Thanks, Dad. Overall, we will not be adding Boston Scientific to our public portfolio. Great innovative company with a track record for outperformance, but from a valuation perspective, we believe it's just run up too fast and will be a prime stock to be pummeled in a market pullback. Thanks for watching this video. If you like weekly videos on innovative long-term focused companies, please help us out and click subscribe, like, or comment. Until our next episode, wishing you best of luck on your investing journey.